Islamic Equity. Equity is based contract, involve partnership and the sharing of risks and rewards in a venture, which is a mudarabah, musyarakah, kirat. Profit derived from capital gains, purchase shares or securities sold at higher price. Profit can also obtain through dividends. The Islamic equity markets cover Sharia compliant shares of companies that do not engage in activities that are considered haram in Islam. These include a venture involving gambling, pork, alcohol, tobacco, pornography, and arms and ammunition. Similar restrictions pertain to companies whose debt is to large extent interest-based or those that derive a significant proportion of their net income from interest payment on deposit held in conventional financial institutions. Such entities are excluded even if their main business is otherwise halal. In addition, equity offerings of conventional financial service institutions, including bank, mortgage, and insurers, and companies with high debt or cash position are also not classified as Sharia compliant. Firstly is the business must be halal, not involved in prohibited activities like gambling, sale of alcohol, or business involve riba and gharar. Second is Islamic equity products must be structured according to Sharia. Features of product must follow the rules of specific underlying concept or contract of the product. And third is profit. Profit should be shared on a pro rata basis. Principal and rate or profit cannot be guaranteed. The PSR depends on the kind of contract, which is mudarabah or musyarakah. And lastly is the share of a company are negotiable only if the company owns some liquid asset. If all the proportion of asset are in liquid form, in the form of money, cannot be purchased or sold except at a par value.
5 components of Islamic equity market. First, Islamic Exchange Traded Fund (ETF). Second, Islamic Real Estate Investment Trust. Third, Islamic Mutual Fund (FOID), stock or share, and lastly, other like Islamic Equity Fund or Islamic Structure Product. What is Islamic Exchange Traded Fund (ETF)? ETF is an innovative financial product that inhibits the best of open-ended fund and listed stock feature. In the Security Commission Malaysia Exchange Traded Fund Guidelines, ETF is defined as a listed index tracking fund structure as a unit trust scheme or any another approved structure whose primary objective is to achieve the return that corresponds to the performance of particular index. What is Islamic Real Estate Investment Trust? A collective investment scheme in real estate in which the tenant operates a permissible activity according to Sharia. An Islamic REIT must also ensure that all forms of investment and financing instruments comply with Sharia principle. According to Sharia compliant, it is an investment instrument that aims to invest at least 50% of its total asset in real estate, whether viewed direct ownership or through single-purpose company whose principal asset comprise real estate. For example, Malaysia's first Islamic Real Estate Investment Trust is KPJ Healthcare Berhad. Islamic Mutual Fund, a collective investment vehicle, pool investor capital into a fund managed by professional manager. Sharia-compliant unit trust or mutual fund can only invest in assets and security that have been pronounced as compliant to Sharia principles and guidelines. There are 4 types of share: common stock, preference stock, cumulative preference, and non-cumulative preference.
Obviously, for a Muslim, the primary benefit of investing in Islamic equities is assurance that the funds are purchasing only Sharia-compliant assets, but non-Muslim investors are also attracted to Islamic equities, so the benefit go beyond the religious. Here are some other advantages of investing in Islamic equity fund. The first one is transparency. Investors in Islamic equity fund expect a high level of transparency. After all, if one of a fund key objective is to comply with Sharia, the fund manager must be quite open about which industry and companies they invest in. The second one is financial screening. Part of screening process for determining whether an equity asset is Sharia compliance involve considering a company financial, including how much debt the companies carry. Islamic equity fund avoid investing in firms that carry very high level of debt. Therefore, Islamic fund may be considered more conservative and slightly less risky than some conventional equity fund. The third one is diversifications. Investing in any fund, Islamic or conventional, that purchase assets from multiple companies reduce a risk of losing capital when disaster strikes and a company declare bankruptcy or close its door. The last one is liquidity. For the Islamic investor, a benefit of investing in a fund versus putting money into a fixed-term investment is liquidity. When situations change and the investor wants or needs to cash out, doing so is much easier when the investment is in fund. Keep in mind, however, that overall Islamic investment, including Islamic fund, tend to be less liquid than their conventional counterpart. And for disadvantage, it's the limited option. The main drawback to investment in Islamic equities is the limited options, whereas investors in conventional equities have so many choices that they can tailor a portfolio to meet any investment objective. However, investors in Islamic fund have significantly fewer funds to choose from.
Islamic funds must appoint a Sharia board to provide guidance to the managers of the fund on matters of Sharia law and, in particular, whether the proposed investments of the fund are Sharia compliant. The Sharia board should be independent from trustee and portfolio manager. Its roles include portfolio purification, selection and monitoring, working with fund management, and monitoring of fund fees and fund documentation. Portfolio purification consists on deducting the income from interest-bearing investments from total earnings and ensuring that the portfolio doesn't include prohibited investment transactions. The supervisory board also oversees the choice of investments by screening stocks that could allow the fund to subscribe to an Islamic index. The selected stocks need to be continually monitored by Sharia boards to check any context change and to remove stocks that fail to comply with the criteria from the fund portfolio. In addition, fund managers may not always be clear on the application of Sharia principles in certain situations or complex financial instruments, and there is likely to be lapses and mistakes with regard to non-compliance, especially when the fund manager is a non-Muslim. Sharia board should ensure that investors are made aware of the fund's risks and how these are structured. It is also involved in the preparation and review of all pertinent legal and business documentation, as all documentation of the fund requires making references to the Sharia and its interpretations.
Now I will continue with Islamic fund. Islamic funds are managed in conformity with Sharia principles, with investment made in instruments that earn profit in ways that are deemed halal. Fund types range from those invest in equities, sukuk, and commodities to real estate investment trusts, which is REITs, PE funds, ETF market, money market funds, and hedge funds. Islamic equity funds are not allowed to purchase, hold, or sell shares of Sharia non-compliant stocks because this would mean a direct participation of the shareholders in the prohibited business. Apart from this general guideline, different equity funds have self-defined imposition for stock screening. For instance, some funds may have threshold limit of 5% on percentage contribution of interest income to total income of the company. These funds mainly generate profits through capital gains or dividend distributed by the portfolio companies. In the case of dividends, a certain fraction of the dividends which corresponds with the section of interest income of the company must be given to the charity. This process is called purification. So I will pass to the next presenter. Murabaha Fund. Murabaha is a sale in which commodities are sold on a cost-plus basis. The purchased commodity were sold on the basis of deferred payment at a negotiated profit margin added to the cost. It can be closed-end fund and its unit cannot be offered on a secondary market. Secondly, mixed fund. The mixed fund refers to the subscription amount used in various types of investment, such as equities, leasing, commodities, and others. If the tangible assets of the fund are higher than 51%, when the liquidity and debts are less than 50%, the unit of the fund may be negotiable. However, if the proportion of liquidity and debts exceeds 50%, the unit cannot be traded. Ijara Fund. Ijara Fund is used to purchase assets such as real estates, motor vehicles, or other equipment for the purpose of lending them to their eventual customers. Ownership of these assets remain with the fund and the customers are paid with the lease. These rentals are the source of revenue for the fund, which is allocated pro rata to the subscribers. Lastly, commodity fund. This fund is used to buy different commodities for resale purpose. The revenue created by the sale are the income of the fund, which is spread on a pro rata basis to the subscribers. Thank you.